Michael Carnevale is branch manager and financial advisor. Securities offered through Raymond James Financial Services Incorporated, 400 Southbridge Street in Auburn, Massachusetts, 1-800-657-9126. A member of FINRA SIPC and are not deposits, not insured by FDIC or any governmental agency, not guaranteed by Webster 5 Cent Savings Bank, and subject to risk, may lose value. Webster 5 Cent Savings Bank is not affiliated with Raymond James Financial Services Incorporated. The information contained in this report does not purport to be a complete description of the securities markets or developments referred to in the material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Any information is not a complete summary or statement of all available data necessary for making an investment decision and does not constitute a recommendation. Any opinions are those of Michael Carnevale and not necessarily those of RJFS or Raymond James. Expressions of opinion are as of this date and are subject to change without notice.
Good afternoon, ladies and gentlemen. I'm Richard Morco with Mike Carnevale, long report, conversations with, and Mike is going to help us learn where we're going in the new year in the world of finance. And he's kind of got a bit of a victory dance to do here.
Rather than try to talk about where we're going, I just want to enjoy where we've been.
He's a happy guy.
December was a massive rally.
It was.
Dow was up almost 5%, almost 1,800 points, closed at all-time highs. First time trading over 37,000. It hasn't been, historically December is a very good month anyways, and it hadn't been a negative December in an odd year since 2015, so we had a lot going for ourselves. But, you know, since late October, the Dow has gained 5,000 points. It's amazing, really. And for the year, the Dow's up 14%, the S&P gained 26%, and the NASDAQ gained 43%. So you look back in January of 2023, and everybody was worried about recessions, inflation, the economy. I don't think anybody would have figured what would happen happened. Double-digit gains in all the indexes. So that's kind of why I think you got to stay invested, you know, for the long term. Because, you know, if you missed out on a year like last year, it's going to take you a while to recover that.
Okay, I usually bug you with the idea that this is just a reflection of coping with inflation. That is, in the 1980s, early 1980s, I don't think we were even in, where were we with the Dow? We were under 2, I think.
Yeah, I was in the thousands.
Low, very, very low.
Yes,
thousands.
yeah.
And now it's up at 30.
37,000.
How much is that compensating for inflation?
I think they say about half of it.
Half.
Yeah.
So that says half of it was just inflation, but the other half is true real growth.
Correct.
How can we be when we don't manufacture stuff in.
Right.
And things we manufacture, Boeing,
Mm-hmm.
Boeing airplane,
Yes.
kind of a little bit of a problem.
Mm-hmm.
So where is what? I mean, I live on a street that, I don't live on that street. I mean, it's near where I live. Long street, lots of businesses on it, lots of factories. Now there's only one factory, and it makes stuff for the governments, for the
Mm-hmm.
government. How real is that to the average guy in the world? And I agree with you. One should stay invested in, say, the S&P or some broad index.
Yeah.
But what is real about it?
Well, I mean, it is representative of what companies are earning. And if company earnings are coming because they're able to produce something at a low cost and sell it at a high cost, as far as the market is concerned, doesn't really matter where it's being made.
But in the S&P 500, there are a lot of issues there that are companies that are not making something.
Oh, sure. Right.
And I'd say, compared to the 50s, it was probably almost all manufacturers.
Right. And now it's all services.
A lot of services.
Mm-hmm.
At some point, don't we have to make something?
Only if you can't make money with services.
So,
I mean, a lot of this is going, where companies that used to make stuff now turn it into like a service model, where, yeah, we're not interested in, making this. We're more interested in giving you this and charging you like a service fee to use it.
if you make that, that's one thing. So where you say, now they're making the all-new spiffy digital one in China,
Yeah.
and I'd say that's better for China and not as good for us.
I think it's probably good for both, though, because both need each other. Don't want to, we're on kind of an auspicious day, don't want to say it, but I'm going to. We said we were going to bring the name up, but I'm going to. Sort of like the Belichicks needed the Bradys, and the Bradys needed the Belichicks. I think it's the same thing. China needs us, and we need China. China needs us because we got the most stable currency that everybody wants.
Stable currency, but it is retreating.
It is, yeah.
So it let it 1950s level stable, 2020 stable.
Well, I think if you look at the economy and the productivity and everything, 2020 was much better than the 1950s.
In productivity and what?
Products and services.
We don't make the products, so it's better for China then.
Yep, but if we have access to those products cheaper than we would if we made them here,
And people have less real jobs.
it's a benefit. Well, no, a lot of those have gone to the service sector.
So flipping burgers is as good as working in the factory.
Well, I mean, I wouldn't go that far, but I'd say, services encompass a lot of things. In the technology field, there's a lot of services.
Say cybersecurity. Somebody in my family works in cybersecurity.
Yeah, I mean, there's a
And
lot.
It's something big that you need,
Right.
but it's not really that great a product. It's kind of.
Well, I think it's, it's. We've become much more efficient. So, it may have took, 50, 60 years ago, may have took 3 people to make a product. Now, one person can make it. I mean, that's
Where?
a big benefit.
Where?
Well, no, in general. In other words, it's taking less employees to produce more.
And that is good for the general population?
Yeah, I think it is. I think it reduces prices and it reduces costs, and otherwise, I mean, you wouldn't be able to buy a TV for $150. You'd have to buy a TV for $750. They come in a big wooden case, and you take 2 people to
I mean, that is progress.
carry it in.
That is progress of a sort.
I think it's
Yeah. And everybody has a TV to, help with their intellectual development, I'm sure.
I mean, electronics. Your phone now is isn't wired on a wall. It's in your pocket. I mean, I think it's, it's all productivity, which, yeah, I think is a big benefit and has allowed companies to earn more, right? Because their costs are less, and that's allowed the market to do better. And although inflation, may account for half of that, over the long period of time, right, you are better off because you are growing higher, faster than inflation.
Who is growing?
Well, I'm just talking like the S&P 500.
The S&P 500.
Yeah, in other words,
And that certainly is where people most broad-based media is probably certainly better than a bank account.
yeah, and the S&P.
But one time the bank account was solid too.
Yeah.
It ain't anymore.
Right. I mean, the S&P, we think of it as, oh, that's an index run by whichever financial firm was offering it. But beneath that, the S&P 500 is companies that employ a lot of people.
And it's the broad swath of
Yeah.
the American.
Yeah.
I can't see if it. I mean, there are. You can probably name a lot of them that are in that are still big manufacturers.
Yeah.
But there's a lot of
service type companies
service type
now,
thing.
right? Which is where, and that's because manufacturing costs are too high here.
So, if we made absolutely nothing,
Mm-hmm.
what would we be sending to China to pay for their stuff?
Well, we'd be making these services.
And what services that we make that China needs that they can't make in China?
That I don't know.
Okay.
I've never been there.
That's
That I don't know.
where we run into the brick wall. There.
Right.
All
That I don't know.
We got to talk about other results.
Okay. So, interest rates fell in the month of December, and when we say interest rates, generally look at the 30-year Treasury. It peaked at over 5%, slightly over 5%, cut down to about 4%. That was a positive sign for the stock market, that maybe interest rates have peaked, and lower interest rates are really good for a lot of people.
Certainly, when I reach 225,000 miles on my car again, I hope it's back down to where I got 1.9%
Yep.
to buy my last car.
Mm-hmm.
So if they work on that, just at that point,
Yep.
I certainly will be happy.
Okay.
But I'm not betting on that one.
No, I would agree on that. And so that's that's kind of a positive, that the Fed has started to talk about. There's a lot of talk about them cutting rates, but the big thing is there's less talk about them raising rates again. So
There
that's
has
a
been
positive.
less. And I'll bring this up now then, how the prices rose. The CNBC today,
Yep.
consumer prices rose 3% in December,
Right.
which we was not reporting back in December. So it's, what it is, Jerry, when I call him, I refer to him, Jerome Powell,
Yep.
Jerry, has he come out and said anything about that?
I haven't heard anything today about it. This is the first, the December result was the first monthly sort of uptick in the rate in a while. There were previous months where there was no change. It was up, 0.1%. So 1 month doesn't really mean a lot. But I mean, if it is a sign that inflation, the rate of inflation has bottomed, that would cause the Fed to think about needing to raise rates again. But with 1 month's number, it's hard to say.
But
But the rate of increase has really dropped. I mean, it peaked at 9% or so, and now it's down to around a 3% annual. So I mean, I think 1 month doesn't really mean anything other than, okay, got to keep an eye on it, because if January's number is also up, and the Fed did start talking about in recent weeks, don't get too excited about big rate cuts. We're going to cut rates, but maybe not as fast or as many times as a lot of people think they're going to do it.
So we're waiting till January. The CNBC number, basically giving pause.
Yeah, I would think so. Yeah, I mean, it certainly was. November's rate increase was up 0.1%, so this is up 0.3% for the month. It's a pretty big increase. If that were to continue, then they may not be cutting rates. They may be raising rates again.
His goal is to get interest rates down.
Right.
If this month, if the upcoming month leads him to go on a stall, can't say he's done very successful.
Right. They meet on January 31st, so it'll be interesting to see what they say at that. I mean, they're not going to, the odds are not predicting any type of change, whether a cut or a hike,
Yeah, I think
but it's what they say. And see if the tone is different than what it was a month or so ago.
Wait till February, folks. Okay, so the technicals, if you want to.
Right. So massive rally of 1,700 points in December, 5,000 points since October. You would expect that the technical indicators wouldn't be in great shape. And they're not. They've weakened. We started this rally back in October when the vast majority of New York Stock Exchange listed stocks were trading below their average price for the past year. Now it's suddenly at 73% are trading above their average price. So that's a bit of a negative. Volatility index continues to be very, very low. That's a negative. The short-term trading indicator, known as the stochastic oscillator, is really in bad shape. I mean, the worst possible reading is 100. A month ago it was 98, and this month it's also 98. So that shows that prices have really risen. And the fear and greed index is now swung from people who are really afraid to people who are extremely confident or extremely greedy. That's a contrarian indicator, so that would tell you that, wow, nobody's really worried about the stock market. And so you say to yourself, well, why would they? It's at all-time highs. But that's the time to be a little concerned, right? Because it's already made a big run. There's a saying that the public's always wrong. They get out after they lose money because they don't want to lose money. And then they get in after it recovers. Why? Oh, because now they want to make money. And so these technical indicators give a number to that. And they're all mathematical formulas that, aren't really, you don't really require to know what the formula is other than the ranges. But they will tell you where you are short term between the greed and the fear. And we're definitely on the greedy area now. And I don't know how many times you would hear people say, "Oh yeah, I'm getting in the market now. Why? Because it's doing good." That means it's already done good. The time to get in.
And they should know they're supposed to say "done well."
Correct. Well, I mean,
That's why they lose money.
That's right. That's right. They don't know proper English, right? And neither do I. No, I mean, and so those technical indicators kind of guide you. And if you follow them along the way, it kind of tell you, well, where are we in terms of short-term indicators? And we're definitely on the really good side for the market, which probably means it's time for things to revert back to the center. So maybe January is not as great.
Do you live by these numbers?
Yep,
So, okay.
Definitely.
But I get that from you. I get that when you say I live by those numbers,
Yep.
you basically say, I just buy steadily and I hold forever.
yep, and if
That's what I'm getting, you and Warren. I call him Warren. Galeska and,
you know all these
and
people
Buck,
by their
yeah.
first name, wow.
Well,
That's
that doesn't mean they
impressive.
know me.
Well, that's true. But no, when I say I put a lot of emphasis on this is because, well, first off, you say you got to be in it long term, right?
Yeah.
So you made money in your house. Why? Because you bought a house and you had it for a long time. Made money in the stock, and why? Because you bought the stock market, whatever that is, and you held it for a long time. Well, the technical indicators allow you to control your emotions so that, yeah, everyone knows long-term returns are great, but you can get spooked out in the short term. And so if you know where the indicators are, say where they are right now, looks like probably nothing's going to happen in January. So if nothing happens, you're not surprised. That's what the technical indicators do. I mean, there's two types. Some people look at the fundamental indicators. What does a company do? How profitable they are or whatnot. Others look at the technical side. It doesn't matter what the company does. You're looking at the overall market and where is it in relation to where it has been. And that's what I would tend to focus on, the technicals. Because many times they keep you in. You know, back in September and October when the market was in bad shape, the thought was, ooh, you got to get out because it's getting worse. But the technical indicators are signaling that, so you're not surprised. You know, it's like if it snows in January, you're not surprised. If it snowed in July, you would be surprised.
I get that.
You want to write that down?
I do.
Yeah.
But I'll do it a little later.
Okay. But the sun was shining at midnight, you'd be worried. If you were in this area of the,
Well, if I
of the
needed a
country.
tan, though.
Well, that's
Which,
true.
believe me, I never need a tan.
But I mean, that tends to keep you centered and not use emotions to make.
Have you ever made a decision because of the technicals to get out at a time? Have you ever done that?
No.
See, that's the thing about this. It basically says steady on.
Right.
Now, if you had been a mature investor,
Yep.
1928, and you didn't get out, it would have been the end of the world.
It would have, yes.
So it's
would have
just
taken you
one thing. It is impossible
30,
to do.
40 years.
Yeah, is to predict the end of the world.
Correct.
So it's basically an argument for staying in.
Yeah. I mean, if you take a look at, and people always revert back to 1929, the stock market crash, lost all your money. That's true. It happened once in 100 years.
It did.
So,
We're coming up to the 100.
yeah, yes. Are we smart enough to, I give you 100 numbers, to pick the one number out of 100? The odds are stacked against you. That's why you have to stay in.
Okay.
And if you do pick it, it's sheer luck. You know, pick a number. I'm thinking of a number between 1 and 100. What is it? Well, if you guess it, it's sheer luck. The odds are stacked against you that you would. So why would you play those odds?
Well, the other argument would be, what other diversity should you seek, other than a broad stock index?
Well, I think it should be in a broad stock. You should, obviously, your home, obviously, banking accounts, money market type funds and whatnot. I mean, as great as anything looks, you should never put it all in one. And that's, people like to do that. How many times have you heard someone, well, if I did it, I'd put it all in. I wouldn't just put a little. Again, that's a mistake. You know? You're going to put it, spread it around. Some you're going to lose your shirt. Some you're going to do very well. Overall, you're going to do probably pretty good. The ones who do the worst are the ones who say, well, I would put it all in or nothing. And if they're right, it's sheer luck. That's all it is.
Okay, we're moving along here because
Okay.
we got some time. So I think we got to move on to ho ho ho.
Yep, we had the Santa Claus rally, which historically is the last 5 trading days of the year, plus the first 2 trading days of the new year. Did good until that 7th day when the market dropped 300 or so points, but still gained 0.1%. It began at 37,404, it ended at 37,430. So about the best you can say. It was positive, which is usually a good sign for the new year. Interest rates, nobody really did anything other than Russia, which raised their rates 1% to 16%. We talked about what the Fed was doing, and every January the Fed changes their voting members. There's a group that's permanent voting members, and then there are 4 members each year that rotate out. So the group that came in is less likely to cut rates than the group that left.
I would think those are good appointments.
Now these are people who've been around.
Okay.
You know, some of them have been there
Right.
10 years or longer.
All right, so all the World Banks basically didn't do anything. Kind of shocked to see the Turks didn't raise.
They did not do anything
Wow.
month of December.
That signals something. I have no idea what. No.
That's
All right.
beyond me.
And then you say the Fed signaled rate cuts in 2004.
Yep.
New voters, okay, you mentioned that. You mentioned the new group is slightly more money hawks.
Yeah.
Tighter money.
Tighter money.
Okay. Oil, low 70s.
Yeah, it continues to.
Hey, no, it went up I think it's up the last few days.
Yeah.
It's 73 or something.
Yeah. But I mean, it's, certainly below where it has been,
And lots of
Production's at a record high.
lots of rigs out there drilling.
Yep.
Okay, so happy days are here again at the pump.
Well, you can get it for under $3 now, so.
That not a victory.
No, but from where it was,
Yes, okay, I'll give you that.
I mean,
And inflation rate of increase decreased.
right, in November,
We're not into deflation.
not into deflation.
Consumer prices up. I brought you the revision from
December,
CNBC. It's up a little more than we thought it was.
correct.
All right. Okay, looks good. And leading economic indicators.
Well, they were down again in November, 0.5%. It was the what was it? I can't remember. I've lost track of how many negative monthly readings it's been, but it's been well over almost 2 years. But the negative 0.5% was actually one of the better readings.
So here's the thing, that we do this every month.
Yep.
This is supposedly a recession signal,
Yep.
and we're giving it a victory dance because it didn't go down
As
like
much.
it
Yeah, and giving the victory dance based on the fact that these other indicators like employment reporting and jobless claims aren't confirming what's happening with the leading economic indicators. So at some point, somebody's going to come out with some type of study of why this indicator is not working.
This is where you have to set yourself apart from the herd, and come up with an indicator on your own that works for you and makes you famous. And The
Yeah.
Carnevale.
Yeah.
The Carnival. they
Yeah,
call
could
it.
that could be.
And,
To see somebody hasn't copywritten that, but
get moving, I'm telling
I'll
you.
try.
Don't anybody tell anybody this, please.
Don't say anything.
Mike needs,
Right.
so that he can retire to upstate New York, or is it Western New York?
It's Western.
Western New York.
I should show you the map of New York, divided by all the, you know.
You should. I mean, really, it would change my life.
There's the
Would
city,
give it-
there's the upstate.
My
there's
understanding of
Western.
geography, just
Yeah.
really.
Either that or watch that Simpsons episode when they drove from their home, which we don't know where it really is, to Buffalo. And it kind of talked all about, well, what's upstate, what's western, and as they were passing past Syracuse into to Buffalo, the voiceover came in, "Don't call this place upstate."
I just remember visiting my son down in New York, and there was we went into a little restaurant type of thing where they had a lot of craft beers, and one of the craft beers was called "Smells Like Upstate." Didn't drink it.
Yeah.
Anyway, all right, jobless claims.
Still remain very low. The number to keep in mind is 250,000 layoffs per week. That's the level that tends to hurt the economy. Last week the number was 218,000, so we're still nowhere near.
I did mention to you early, before we came on, that government and I have a statistic. Government and social assistance accounted for nearly 60% of the job growth.
Yeah.
So that and that other number, that number that you give, how much do we trust them?
Well, as long as you're comparing the same thing period after period, doesn't matter really what the number is. It's more the trend.
Well, this wasn't a good trend that I.
No.
Okay, that was a whole year's thing of
Right.
phantom job growth.
Yes.
Okay, the employment report.
That continues to do well. We've had 35 straight months of job gains. Generally, the economy needs 150,000 to be okay. The month of November was 199,000.
So, all right, we've had the monthly report it was a good December, especially if you stayed and it stayed the course.
Not likely to be as good a January.
And not let, well, we will know. We will come back to visit with us in February. It's been Richard Morco and Mike Carnevale, Conversations with, the Long Hill Report. Have a great January.